I want to just go ahead and honor our start time here and get things going. It is 1 minute after 12. Usually I give it a few more, but I know that people are going to continue to keep coming in, and I want to make the most of our time and get as much information shared with all of you as we can possibly get out there today. This is our LifeNet Global Connect call. This is where we just bring resources to you as a community and just share that. We want to encourage you, be on these calls, encourage other people to join us on these calls. This is open to everyone. And if there's a topic that you see that's something that's interesting or important to you, tell others about it too and get them on here. Last month, we did a call on velocity banking, which was a new concept to many of you. And we heard it with a bit of a twist about using home equity lines of credit in a way to go ahead and build wealth or pay off debt. And we talked about that strategy a little bit. And one of the things that I oftentimes and have been helping my students with that I coach for many, many years is using that as a strategy to, and I use the term turbocharging your returns. Now, in the midst of that, when that came up on one of our discussions, I had brought up the idea of turbocharging your returns and using these lines of credit to do that. John Blalock was on that call, and I had already been in discussions with John about infinite banking. And he said, you can use infinite banking to turbocharge your returns as well. And I'd love to share with you how you can do that. And I said, well, John, I would love for you to share it with the whole community because I'm learning more and more about this. And it's an extremely intriguing concept. It's something that I like and am very, very likely going to be taking that step myself here in the very near future. Getting things up and running with it. One thing for certain is I will almost definitely be getting policies up and running for my kids and teaching them how to use this as a wealth building strategy for them. But I want everyone to approach this with an open mind. I'm just going to tell you right up front, one of the things that is going to be talked about here is life insurance. And oftentimes when people hear about life insurance, they immediately want to take a step back and be like, oh, wait a minute. And that was my initial inclination. The very first time somebody talked to me about it, I had already had discussions with people who said, oh, no, you don't want to do that. That's wrong. It's not a good strategy. But when what we're not doing here is we're not talking about life insurance. We're talking about a wealth building strategy called infinite banking, which utilizes life insurance as part of the process. And so, as soon as you hear something like that come up, I don't want you to just shut things down and dismiss what we're going to be talking about. I want you to look at the overall strategy and listen to the entirety of what infinite banking is, because it is a very powerful tool, and it is something that the sooner you get up and running with it, the more powerful it will be. And so it's one of the reasons why I certainly want to get things up and running for my kids sooner than later, because it's a strategy that over time can amass great wealth. And so with that, I am just going to turn things over to John Blalock, who is our guest today, and he's here with his assistant. I'll let them introduce themselves, and we'll get this thing started. So, John, I'm going to go ahead and turn things over to you.
Great, thanks, Steve. Hey guys, I'm John Blalock. This is Ashley Moman.
Hi there. You'll likely see a lot of the top of my head as I help out with some tech. So,
yes,
just giving you fair warning, guys.
Yeah, so we're going to do this together. We're at Birmingham, Alabama, and I've been in the business for 15 years, started out doing traditional wealth management and was introduced to Nelson Nash, who's actually the creator of the infinite banking concept. And it was just really being fortunate that he was in Birmingham, and so was mentored by him for a little over a decade, and he would come drink our coffee, and I was slow to adopt this at first. Took me a couple of years. I was definitely cynical because I was brought up in the traditional world. But with that, we're just going to dive in because we're giving you guys what we normally break into 2 sessions, and we're going to try to do it in 45, 50 minutes. And so we'll go fast and then definitely game to take questions at the end. And so our goal is to add as much value, educate you guys as much as possible. Definitely want to say that this concept, the infinite banking concept, and the way we teach it is not to change your real estate strategies at all, or the way you in your business. We're not trying to change that at all. It's just really a way to enhance what you're already doing by warehousing the cash that you use in real estate or your business to perform better than when that money resides in traditional savings products. And also the goal with infinite banking and the result is to give you more control. And so our assumption is that you're currently stockpiling money somewhere to use for future deals. An example could be the cash you put in a property or project. And then we know a lot of times people go and get lines of credit on those properties. But that savings cash that you're using could be run through the infinite banking system first for your money to work twice as hard, essentially doing 2 things for you at the same time. It also gives you a substantial amount of freedom and control in a constantly changing financial environment now and going forward. So we are going to switch gears and jump right in.
I know that this is coming, but I'll just also throw in that there's tax advantages to this as well as liability protection.
That's correct. For sure. All right.
Okay.
Cool. So to start out, we're going to look at a savings account, could be a CD, could be a money market, versus a specially designed whole life insurance contract. And then we're going to look at the trade-offs for each. So to keep things simple, we're just going to look at a 7 to 8 year time frame. You can see the years there. And, and also for simplicity, we're just going to give you an example of numbers. Your numbers might be totally different, but whether your deposits would be less or greater, you can know that the concept really, it works the same. So please don't get hung up on the numbers. So let's say for the next 7 years, you're planning on saving a certain amount of money into a savings account. So for the first 4, you're going to be depositing $35,000 a year. And then in years 5, 6, and 7, you're going to make annual deposits of $12,700. And then we're done. So in the first year in savings accounts or CDs, knowing today's interest rates environment, if you put $35,000 in, how much do you have available? Steve?
35,000.
Yeah.
Yeah. So in year 2, we're going to add another 35,000. And so in which you would have 70,000 available. So we're just going to keep doing these deposits to this savings account. And at the end of year 7, you have saved $178,100. And you might have a little bit more, due to interest, but probably pretty close to that amount. So you've stopped in year 7. So let's look at what's going to happen from year 7 to 8. Maybe it grows to 178,200. We'll give it some interest growth. So now we're going to switch gears and look at the IBC account. So the IBC account, again, is a specially designed whole life insurance policy designed as a savings warehouse. It's also known as the infinite banking concept, but we're going to call it it's also IBC, you hear that, but we're going to refer to it as the IBC account. So we'll keep the deposits the same and check it out. So in year 1, when you put $35,000 into the IBC account, you will have access to $23,000. Right out of the gate, you can see the trade-off, which is $12,000. So that's probably bringing up questions for you, which is normal, but for now, it's important to know that you're not going to lose, you're not losing that money. You just don't have access to it yet. It's not lost. So in year 2, if we add another 35,000, we'll have 59 available. And so our trade-off now has gone down from 12,000 to 11. So important to note that money isn't lost. You just can't have access to it yet. And we're going to explain why. So for the remaining years, we're going to make the deposits the same, just like we did the savings. And when we get to the end of year 7 with the IBC account, we'll have $184,000. So again, let's look at the next year. We're not adding any money past year 7. but the policy will grow from year 7 to 8 from 184,000 to 190. And so we can see here that the IBC account, it will catch up for that initial trade-off, and then obviously surpassing the savings account. And so, that trade-off in the first couple of years of some limited access, it's not for nothing. And so what do we get for it? Well, right out of the gate in day one, we're getting a death benefit with the IBC account of $1 million. So we could think about it, hey, we traded some access, a little bit of access in the early years to some of our money, but we did secure a death benefit. So in year one, if somebody passes away with an IBC account, their family's going to get $1 million. Whereas with a savings account, obviously their family would get $35,000. So with that death benefit, I mean, it is, something significant for the trade-off, although we'll say that infinite banking is about cash and an efficient warehouse, but our primary objective is not death benefit. In addition to that, we get a tax-free bucket of money that grows tax-free. It's accessible from day one, tax-free if designed correctly, which is why you really don't want to go do this with anybody that sells life insurance, or there's a lot of people online saying they're doing it the right way that unfortunately aren't. In contrast, if we think about savings, if we do earn interest with savings, are we going to pay tax? And we would. We haven't earned anything in a long time, so we've kind of forgotten, but we would. But the IBC account is tax-free, and it's guaranteed to grow contractually. In addition, we get credit protection, and it varies by state. Most states the credit protection is really strong, but it is dependent by state. So, whereas the money that resides in savings accounts, money market CDs, that money unfortunately is not protected from creditors. So let's fast forward 20 years. Again, we haven't added any money. We're just looking at growth. With a savings account, depending on future interest rates, who knows, your savings account might have a little growth in it. We're going to guess and say that it maybe has like 185,000 in that traditional savings account. In year 20 with the IBC bucket, we would have 310,000. So there's a gap there of about $125,000. And every year going forward, that gap is going to get bigger and bigger. And obviously the savings account's never going to catch up. Someone passes away with a savings account, or this savings account in year 20, their family's going to get 185,000. Whereas if they pass with the IBC account, their family would get $1 million. So it is a legacy, even though it's not the focus. The major purpose of IBC is to grow that savings bucket, but the death benefit does stay. And so the trade-off in those first couple of years, that's temporary in the IBC bucket. But the trade-off for most CDs and savings not having guarantees, not being tax-free, not being credit protected, and no death benefit, I mean, those are really permanent. So the question we ask is this temporary trade-off that goes away in these early years, is it worth having an account that is guaranteed to grow, does so without taxes, provides you credit protection, does give you a death benefit, but more importantly, your savings warehouse grow to a whole lot more money? Can you be okay with that trade-off?
And John, if I can just add something else, because I picked up on this the last time you were showing me, is that trade-off for all intents and purposes is absorbed in year one. In year two, when I add another $35,000 to my bucket, I basically have access to all of that because the trade-off was taken in year one. So if I put another 35,000 in, I have access to it. So it's almost a one-time trade-off that we recoup in time.
That's correct. Thanks for pointing that out. For sure. So we're gonna keep peeling the onion back a little bit, and one of the things that is important that we do is that we define the difference between savings versus investing or investments, because unfortunately the words, they've been commingled, and it's important that we not use them interchangeably because they're really not the same thing. We would define savings as money that's safe, it's liquid, you can't afford to lose it, you don't want to lose it. Typical savings instruments we're all familiar with would be like bank savings accounts, CDs, money markets. Whereas in contrast, investments or investing examples would be real estate, brokerage accounts, IRAs, etc. And with investments, as you guys all know, we're taking risk for a higher chance of return. And with that risk comes the possibility of loss. A lot of times investments are more longer term, they're not as liquid, and usually have tax implications today and in the future. And we're here to say both buckets are good, like, and both have their place. It's just important that we don't commingle the terms or the monies, and that we keep them separate. So today we're talking about the savings bucket, which is used for, while it resides there, it's used for cash that you put in a deal, emergencies that come up, large purchases, a lot of times, debt control, cash flow management. And so understanding the difference is super important. And it's also that we don't let savings dollars inadvertently go into an investment bucket. So we're going to continue on and educate you guys about the different types of life insurance, and especially how infinite banking is totally different than what people are familiar with or hear about. A question we get a lot is permanent life insurance expensive? And we would say that the majority of policies, of permanent policies out there, they probably are expensive, but properly designed whole life insurance contracts it's completely different. You're going to see why, because they're really designed for cash and utilization, to use the money. So when we look at life insurance on a spectrum, on the left, you can see is term insurance. It's the most popular. People think that it's the cheapest. But unfortunately, most people outlive their term time frame, whether it's 10 years, 20 or 30 years. And an unfortunate kind of sad fact is that less than 1% of term policies ever pay out a death benefit. And the reason is because the people just outlive the time frame. Moving to permanent, you have variable universal life, indexed universal life, and whole life. And we would argue that whole life is the only one that is truly permanent. So going to the universal and digging deeper there, the reason we want to really educate and differentiate anything that has the word universal from whole life or IBC design is because there are a lot of people out there, and we're running across them a lot, that are advisors or insurance agents that are saying they're setting people up with infinite banking, but they're using index universal life. And we want people to understand the difference. So with an universal life or index universal life, there's two components. And on this graph right here, you can see the horizontal is a person's age, going from 30 to 85, and the vertical is cost, 0 plus. So as people put money in, there's two components. There's the insurance component, the cost, and there's an investment component. The cash of the investment component could be tied to a stock market index that is capped. It could be just general interest rates, mutual fund performance. It depends on the type policy. But the investment component, part of this makes it not a savings bucket. As people age, more and more of that money is getting gobbled up in cost, and less money is going to into the investment side of it. And what we've seen a lot of is that the cash can go backwards in these kind of policies. And because of that, it violates our definition of savings, and it makes it not an ideal tool to use for infinite banking. So in addition to that, we don't want to put our savings dollars at risk of loss, nor do we want to commingle the savings bucket or investment bucket. So looking at whole life, if you're just buying whole life for death benefit, it takes more dollars if you're just trying to get death benefit. But we're doing the opposite. We're building these for cash. It does have a death benefit, which is a legacy, which is great, but that's not our focus. So let's dig on this spectrum. It's a different way to look at it and see some of the differences. So on the right hand side, you can see that it's would be low cash value. You're going for high death benefit. And so you see there's term, which has no cash. It's like renting, and you're going for as high death benefit for the cost. Then you have the ULs, the IULs. Let's just say they have some cash and a medium death benefit. Traditional whole life policies, we would say have slower cash and a medium death benefit, but that's not what we're using. And when we hear the talking heads on TV talking about kind of bad mouthing whole life, that's what they're talking about, just plain Jane whole life. And it has its place, but that's not what we're doing. With infinite banking, we're going for higher cash, lower death benefit for however much money someone's depositing. And so you can see that red vertical line, it's called the MEC, we call it the MEC line, it means modified endowment contract. A little bit of history of why that line exists is that, it's going back as far as 200 years ago, uber wealthy families like the Rockefellers, Ray Kroc, Walt Disney, and even today, people are doing it. They were going in on that far left and doing single premium deposits and buying just a sliver of death benefit. And they were doing it because it was a very nice tax shelter. And so in the 80s, the government, the Congress at that time came in and said, hey, wait a minute, that's not life insurance, that's just a tax shelter. So they created this MEC line. And so what we do is we're building these infinite banking policies to hug up right next to that line. And an easier way to say is the majority of the dollars are being directed to cash, as few as possible to death benefit. And inside this proper design, the cash accumulates and it cannot go backwards. It's tax-free because we're structuring it in a unique way. Year one, as Steve mentioned, it looks expensive, but by year 7 or 8, we would say infinite banking is the least expensive because you have more money than you put in. Plus, you get to use the capital from day one. You still leave a death benefit and a legacy to pass on. And so, yeah, we're going to switch gears and show you some more numbers.
So before you go any further, some of the questions that people might have may be answered later in your presentation, so we won't answer them. But is there anyone who is sort of lost at the moment? Do you need further clarification in any of these areas, or are you good? You can type your questions into the chat. Keith asked, why is only whole life permanent? And I'll try to answer it from what I heard you saying, John, and you can correct me if I am wrong. But from what I understood, the universal lives, the problem is they can go backwards in time, that you could actually start, continuing to make your contributions, but they're going to have to draw off of your cash value to make up the rest of the insurance, and that is a possibility, whereas whole life, you never go backwards. Is that the reason why one is permanent versus the other?
I mean, technically, the universals and whole life are permanent insurance as they're labeled. But for our definition, we would say that whole life, and especially whole life in general and infinite banking design, is the only true permanent one because the cash cannot go backwards. We see a lot of sad stories with people with index universal life and universal life where the companies they push down the participation rates of the index, and then the cost of insurance is going up, and people are putting money in, and that money's not only what they put in is evaporating, but it's digging in and eating at their cash value, especially in the later ages. I know my grandparents had one that was a pretty sad tale. I've been in the business 15 years. It was done a long time. I think it was done in the 80s. But yeah, that's our short answer or long answer.
All right. So hopefully that gives the answer. So then there's another question here. What is the death benefit at the MEC line based off the example that you were showing with the 35,000 per year going in? That was sort of a real example, but not necessary for, not necessarily for anybody in here. It will vary depending upon each person, but in that example, you were discussing $1 million death benefit for that 35,000 a year that was going in. And so if you were to not use this strategy, that death benefit for a $35,000 a year contribution could be significantly higher. Would that be true? Wouldn't have as much cash available to you, but the death benefit could be higher.
So the person that we're running these, everyone's numbers are going to be different. And what's interesting is people will ask me, hey, what I want to do infinite banking, but how much, what's $1 million or $2 million policy? And I'm like, I don't know, because our focus is how much do you want to save in this warehouse to deploy in investments? And the death benefit is the last thing to get kicked out. Of $35,000 in this example, we're having as little bit go to purchase that death benefit, but the answer, it's $1 million. If we took 35,000 and try to get as much death benefit, we could have more. But it just, what are you going for? If you want to get the most amount of death benefit for the least amount of premium, but not have a warehouse that you can do deals out of, then maybe that's a fit for some, but you could have more. And so we all want our cake and eat it too. We want high cash and high death benefit. Our focus here is cash. And I think some of the chats that are coming up as far as IRR and different things, I think we will tackle a good amount of them as we go.
Yeah, the rest of these questions are going to be addressed further in the presentation right now.
And also just to realize that we did run these numbers on a 45-year-old female to give you some context. So what you're seeing is what if we had the health rating on a 45-year-old female and she wanted to do 35,000 in deposits. This is what her death benefit would, to your point, be $1 million. And then this is what her cash value and such would look like. Fair to say?
Yeah. Okay. And age is not, as we're going to get to that, age is not a big a deal as people think it is, because it is if you're trying to buy a death benefit, but when you're going for cash, it's not as big a deal, but we'll definitely get to that. So cool. So what we have here is we're going to start with the savings account where we were saving that same amount of money over 7 years. And you see we put 178,100 in it. Right now, we have no earnings rate here. And so the balance is stuck at 178. So we're going to build this first and then compare it to the whole life. And so again, this is a 30-year time frame. It's a pure savings account. Think about it as a money market. Right now, earnings rate set to 0. So we need to assign a rate of interest, because right now interest rates, and have been for over a decade, super low. But historically, we know they fluctuated. Like in the 80s, they were double digits. And so let's assign a rate in taking into effect historical fluctuation and that interest rates could rise in the future. Thinking longer term, we're just going to go with 1.5, saying, hey, we got a money market that's paying you 1.5% today and through the course of 30 years. And in reality, since we're close to 0 or next to it, and for how an unforeseen amount of years going forward, the reality is if we're 0 right here, just to do what 1.5 consistently is, we would have to be earning probably 2s, 3s, and 4s on the back end or higher to make up for the fact that we haven't earned any and currently not earning anything on CDs on that safe liquid bucket. So we're going to go with 1.5. And so here's the earnings right here, around 91,000. And so if we do, Steve, if we did earn this kind of interest on savings, would we have to pay taxes on it?
Of course, yes.
That's right, we would. And so because of that, we need to factor in taxes. Quick, not a CPA, consult your tax person if you have questions about this, but it is true that on CDs, money markets, savings accounts, when we earn interest, we pay taxes at our highest marginal bracket. When you go and file your taxes, your effective rate or percentage that you pay is lower because it's a blended tiered system. But we all do pay at our highest marginal bracket. Everyone's is going to be different on this call, some higher or lower. So we're going to go with state and federal highest federal and state at 29%. So before we did that, and I'm going to take taxes off so we can just have a memory jog. Without taxes, the savings account had 269,000. Now we put taxes on and we're at 239,000. So you can see here, we're paying $25,000 in taxes. We're taking the money out of this account, paying Uncle Sam, but our account went down a total of 30. So Steve, where did that extra $5,000 go?
You tell me. The government.
So, and I didn't ask it in a good way. So we're paying $25,000 in taxes, but our account dropped 30,000. So we lost a total of 30, but we only paid 20.
Compound interest.
Yeah, lost gains in the earlier years.
That's right. I didn't ask it very well. And it's because when we extract this money out, that's the lost future earnings of that money not being enjoying that 1.5%. So, our goal is to be as tax efficient as possible. And so now we're going to look at this IBC account we were looking at abbreviated earlier. And so here you can see it's the same. We're doing the same deposits, but look at year 30 with the IBC account where we've got about 482,000 compared to 239. And I mean, are we doing anything different? It's the same. You guys may be wondering why, how is the infinite banking account earning so much more? And the reason is because contractual guaranteed growth is a big part of it. And the other are dividends, which are not guaranteed. And that's important for people to hear that dividends are not guaranteed. The companies we use have not missed a dividend for 200 years, but again, dividends are not guaranteed. So more money is great, but we also have that tax benefit. And that's because we of the unique design to keep it tax-free. And again, that's why it's dangerous for people to go do this with just Joe Blow down the street that says, oh yeah, I can do that. And so what's the trade-off? And Steve was saying, pointed out very well, 35,000 in year one, we only have access to 23, but the next 35, you're getting dollar for dollar. But so in that year one trade-off of not losing it, but limited access, the reason for that is with that part of the money, we're actually buying the life insurance to get the tax advantages for the whole life of the deal. And so you can see this gap lessens to where by year 7, we have more money than we put in. And then obviously it's going to overtake, and the death benefit does stay with us. So to some of the return questions, this isn't exactly what the person asked, but we'll get to it. It's a struggle for all of us to try. A lot of people want to compare the returns of infinite banking to an investment bucket. And those are really apples and oranges because this is a safe asset. Investments have risk. They're both good, but return is important. So what we're showing you right here is what this 5.13 number means is that if you had a taxable account that was in a safe place, couldn't lose, and you could earn 5.13 starting today over the next 30 years, you could have the same $481,000. But we don't know of any savings accounts like that that exist today. And since we don't have that, the reality is we have to earn so much more in future years to catch up. And so how realistic is that for someone to have? Quickly want to point out, if taxes go up on this person and suddenly they're not in a 29% bracket, but now they're at 35 because taxes have gone up. Now that means just to match what the infinite banking account would do, they'd have to be earning 5.6%. So the higher taxes go, the more attractive infinite banking as a warehouse for savings to then be deployed into investment becomes. So now we're going to look at utilization, which is a whole lot more fun, how we use the money.
Definitely know that a lot of you had questions about utilization, so we're definitely going to cover those as we get this going.
Yeah, just got to move a couple of things. Appreciate the patience. Here we go. All right. So we built 2 example accounts, and now we're going to use them. We're going to go back to a bank savings account first, and then we'll look at infinite banking. So, for simplicity, we're just going to look at a $50,000 one-time purchase. And so it could be a bigger amount. It could be, it doesn't, we just had to pick a number. So first, let's note what this savings account that was earning 1.5 and unfortunately is paying taxes. It has $239,000. So this is just no activity yet. Awesome. Gotta move this. There we go. I'll be able to get to it. All right, awesome. So what are the ways we typically get money to do a deal or to make a purchase? We could either borrow money from a bank, we could borrow money from a lender, there's private lending, or we could pay cash. And then we're going to introduce you to a third way of the infinite banking way of doing it. And then we're just going to look at all 3 and compare and contrast. So let's start with a traditional loan, like a bank loan. And so we're going to do a market loan. You're borrowing somebody else's money at $50,000. You can see here's the money coming to you. And we're doing it's over a 5-year payback. We assigned a market rate loan rate of 3%. You can see here, this is the payback over 5 years. And what that represents is like a $900 a month payment. And so with this kind of loan, do you have any flexibility? Not really, right? And if you can't make a payment for a couple months, what's going to happen? They're going to come for the asset, try to, credit's going to get hurt. It's going to be a bad day. And so when we borrow this money, our savings account didn't go down because we used their money, but we are paying interest to use their money. So it costs us $4,600 in total to borrow their money and not touch our savings. So the other thing to note is, or to ask is, and I love asking this, is like, hey, for you, Steve, what bothers you more when you borrow somebody else's money, the interest cost, or like the loss of control, the forced monthly payment?
Both.
Yeah.
I don't like either one of them. So, I always do everything I can to avoid the monthly payment, because cash flow to me is one of the most important things, and not having to make that payment.
Yeah, that's what we hear the most from people. There's no right or wrong at the end of the day, but most of us, as Steve said, we don't like the payment and we don't like paying interest. So how do we get rid of both? I mean, we have the cash in the savings account here, so let's just use it and see what happens. So what we've done here is we've just withdrawn $50,000 from the savings, and we got to pay cash. We got rid of the payment, but did we eliminate the interest? And so if we look here, it's saying that our interest cost was $18,000. So we got rid of the payment obligation, but when we borrowed somebody else's money, it cost us $4,600 in interest. And now that we've paid cash, our account balance went down to 171, and it's saying that the interest cost is 18,000. And this was answered before, like, what does this represent? Why is it saying it cost us 18,000 when we paid cash? It's because it's the lost earnings potential of this 50,000. When we removed it from the account, it's no longer earning that 1.5%. So we lost more in interest paying cash than if we just borrowed somebody else's money. And the cost of that
if I
money,
can, John,
yeah,
I'm just going to give everybody a brief summary of this. What John is showing here is if you're a person who likes to pay cash, but when you save up and you have enough money to pay cash for something, and you take your cash out of your account, he's trying to demonstrate the actual cost of using cash to pay for something that with the lost earnings. And he's going to contrast this to the infinite banking concept, where when you're accumulating that cash value and you actually take $50,000 to purchase something, you don't lose the interest that you can gain based off the infinite banking concept. And so I just want everyone to understand what he's showing here is that you actually lose money versus an infinite banking concept when you pay cash. If you're using your own cash to pay for something, there's a cost to it.
That's exactly right. And I know everyone wants to see the infinite banking. We're definitely getting there. And so, you know, the reason that money not being in there, that is growing, that cost is growing. And another way to say it is, you know, it's compounding. But most people think that it's better to, like, most people, I know I was taught, my parents like pay cash than it is to pay interest to someone else. But what we just saw is it costs more. That, you know, the numbers are showing us we lose more paying cash. And that's because of that lost potential growth in those future years. The talking heads on TV all say that we should pay cash. And that's what I used to do. But when I saw these numbers and that it was costing me so much more to pay cash than financing, I felt kind of pretty lied to. But fortunately, Nelson Nash was a mentor of mine, and he was, again, the creator of the infinite banking concept. He would always tell me, he'd be like, hey, John, you either, you know, you finance everything you buy. There's always a cost. You either pay interest to use somebody else's money, or you give up interest you could have earned. There's no way around it. And I think what makes it hard for us as Americans, and probably the world, is that we haven't earned any interest on our safe money in over a decade. So it's made us forget that our money can earn. But as we've seen with the infinite banking, there are places like IVC where safe money does earn interest. And so, by paying cash, not paying back, our account value went to 171. And so would it make sense that if we paid ourselves back the cash we took out of the savings account, shouldn't it reduce that interest cost and increase our balance? So let's give ourselves a 0% loan. So we're not charging ourselves any interest here. We're just replenishing. You can see right here, we're just paying back the 50,000 we took from the savings. And so our account balance is now at 237. So far, that's our best case scenario. When you're replacing money or replenishing a savings warehouse or a savings account, does it, you know, does it feel like you're making a payment? Like, does it feel like a car payment? You know, I mean, who's in control of the timing and the amounts? And to us, it feels like you're just saving, not a forced payment like a car payment. So just by paying the principal back, it had a dramatic effect. So if we paid our savings back, principal and interest on top of it, you know, would that completely eliminate the cost? We saw just by paying back the principal, it reduced the interest cost. But if we pay back with interest, would it do it? And this is really where infinite banking comes into play. A term that Nelson Nash introduced to me, it's actually in his book. It's called EVA, for economic value added. And what economic value added is a concept discovered by an accounting firm that was doing consulting with big companies like Coca-Cola and CSX Railroad in the 1980s. And basically they went to Coca-Cola and said, hey guys, you should treat your money the same way you treat money from banks for projects and pay yourself back with interest. They're like, if you use your capital, you should pay yourself back at the same rate a bank would have charged. So we ask people, hey, if the bank's dollars are worth 3%, you know, what do you think yours are worth? And so let's treat our money the same way and pay ourselves back. And we're about to get to infinite banking, but we're going to do it and show you that with cash, the principle is sound. So we're going to pay back this savings account at 3%, just like the financing, outside financing. And what happened to our balance? So now we're at 243. So we actually created some additional wealth in the account by paying ourselves back. All right. So, and also when we do that, we've reduced the amount of lost future earnings. And remember, these aren't, it's not a payment, it's a deposit back to yourself, because you're in control of it, when and how you do it and the amount. So does it make sense that treating your money the same way as a bank treats it is the most efficient? Hopefully that we're able to convey that. So now let's look at the infinite banking that we created. And we're just going to combine that same tool, the tool of properly structured whole life insurance contracts with the principle of treating your money the same way a bank does. So I'm just loading in the IBC policy we looked at before. So I've got to change that. All right. So now we're looking at the IBC account we created last time, and we're just going to do the same deal. But what do we know right now? You can see we still have taxes on here, but what do we know? And Steve said it. What do we know about infinite banking? That it's tax-free. So we're going to take the taxes off, which makes a huge impact. So here's a $50,000 that we got, and we're going to pay it back over 5 years. The loan rate is 5%. So the account, our best case scenario was 243. Using the infinite banking method way, we've got $482,000 in cash. So we got the item. So a question we ask people is that gap from doing it with a savings account or CD, 243,000 versus having 482, is that a bigger or smaller gap than you expect? A lot of times we hear both, but we hear most of the time that it's a bigger one. And you might be asking yourself, why is there such a substantial difference? And the reason is, because why is it so substantial? Our deposits didn't change. Did the cash flow in and out change? Not really, not much. And so the reason is, if we look at these earnings rates, and so these are the earnings rates that I saw a flash come up of the chat of, everyone wants to focus on rate of return, which the real power of this is not what this does, but what you can do outside of it. And so notice in year 2, we needed, the cash value didn't change. But in our case, we had $59,000 available to us. We needed 50,000. So when we utilize this money, that $50,000 becomes collateral with the insurance company. And so, whereas when we pulled 50,000 from the savings account, we saw a dramatic impact. And so why don't we see, one question is, why don't we see this with life insurance? And the reason is because we're using the insurance company's money while our money grows. The amount available to you to borrow is equal to whatever your cash value is. In this example, we had 59,000, so we got 50. And again, when we borrow their money, that amount becomes collateral, but we still retain the control and the ownership of when and how we pay it back. There's no monthly required minimum payment. It's total freedom and control. We use mutually owned life insurance companies that are actually obligated contractually to loan to you first, because you're an owner of the company. There's no loan applications. There's no questions. Use it anytime, anyway. As far as how fast.
So John,
yep.
I don't know if you're going to have a slide with a visual of this, but I'm going to just try to paint the picture. If you have the slide and you can pull it up, I just want to paint a picture for everyone so that they can really understand what you just said right there. I want everybody to just look at this as two different buckets. And one bucket is your life insurance policies, where you're putting cash into it. That bucket has a guaranteed return, a contractual guaranteed return that you will always collect money on. When you borrow against your policy, you're not taking that money. That money is going to continue to grow. Instead, when you borrow, you're going to borrow from a different bucket. That's the insurance companies. And there's been some discussion going on in the chat, but for purposes of just trying to help everybody out here, so you have an understanding, your guaranteed bucket, my understanding and the number that I have heard over and over at this point, and I would imagine that this can change, but it's a guaranteed 4% that you're being paid on your money. It's growing at 4%. And here's the key is you never touch that money. It just grows. It never comes out. When you need money, you come and you borrow from the insurance company's bucket. And the insurance company it's their money that you're now using. And what John just said right there was very powerful, is there's no qualifying for it. As long as you have the cash value in your bucket, you can borrow that money. You don't have to pay it back. There are no exact terms, to that loan, but they charge 5%. You're getting paid 4%, and they're going to charge you 5% on your money. Now, this is where the infinite banking concept comes into play. Instead of you going to a bank to borrow the money, you're basically borrowing against your own money and paying yourself back. And so this is what the examples that John is using right now are ways that you would utilize your own money for doing things. And some of you are more advanced in your thinking here already, but you can use that money for investing. You can actually maybe now you've got this cash value here that can always grow. You never have to take it out. You never have to touch it. It's tax-free. It is protected from creditors. And then you borrow from the insurance company at 5%. Maybe you do a hard money loan at 12% or 15%, or maybe you invest it into an investment property that's making you 10 or 12%, and you pay back the insurance company to free up your funds again so that you can use them all over again. But I want you to just start thinking of terms of buckets, and try to have that picture. There's your insurance bucket, and then there's the bucket that you borrow from, which is the insurance company's money, and that's where the loan is coming from. So yours always stays intact. It never goes down, and that's the power of this. It's always working for you, continuously working. If you went and you withdrew that money from your account, you're not going to get interest on the money that you withdraw. But when you leave it in there, it just keeps on growing. And that's part of the power of this whole infinite banking concept. So hopefully you can put that picture in your mind. And John, I don't know if you do have a slide that actually shows that or gives it a little bit of a visual, but I just wanted to clarify that. I'm getting some private messages where people are not quite understanding.
Yeah, I appreciate you. The way we show it here is if you watch your IBC account value, and then as I take the loan off, it doesn't change. It's not letting me. It's too much happening. Yeah.
There you go.
All right. So when I've got a lot on the screen trying to block me a little bit, but the whole point is it's just like if you have a piece of real estate and you have a line of credit on it, it's going to appreciate in value regardless of the fact whether you have it paid for or you have it mortgaged. And the same is true here. We're borrowing against the value of a contract that is growing in it's uninterrupted compounding. You can think about an account that grows tax-free, uninterrupted, that has a line of credit attached to it. And as Steve said, they're completely separate components, as opposed to take your money from one place, it's lost its earning potential, and now you got to make a choice. And to the 5% is that it's not, that's one thing. People are like, hey, 5% is high. And really, this is just one place to access capital. With our clients, depending on what they're doing, we decide, hey, is it outside financing? Is it to borrow the insurance company's money? What is the best? But if this is the only place that you could access capital, would it be worth it to you to pay them $7,700 for your account to grow uninterrupted and you to have a whole lot more money than 243 the old way? And so, ultimately there are a lot of other factors than like pure rate of cost to borrow. Our biggest one is control. And so each time you need capital, you might make another choice. It's just giving you another option to have freedom in control. There's a lot of people saying they're doing this and and I was going to run through a couple of common like myths.
We can show that loan example.
Yeah, we'll show like how the interest is calculated. But there's a lot of people online that are setting these up for people and they're not doing it properly. They may build it, but you're on your own after that. And the way we work, what they're offering is transactional experience. What we're all about is a relationship, and we meet face to face or on Zoom with people and not just set it up the right way, which we do, but we're not going to send you a frequently asked question and say, hey, you're on your own, figure it out. We're going to make sure to build something that's sustainable for people and help them utilize it. Some common myths or misconceptions: I'm too old, which we talked about. Well, if someone's in their late 60s, maybe that might be the case, but they could own a contract on one of their children or a business person, and they could control the money completely. Or I'm not healthy enough. Again, you could own one on somebody else. Or, hey, John, I can do the same thing with my line of credit. I get this one a lot. With a line of credit against a property, you just have the property appreciation, and you risk not having control of your bank calling in that loan. A lot of people think that won't happen, but it happened as recently as 13 years to a lot of people. And so with running money first through infinite banking, you can still buy the property, you can still get the appreciation, and you still could go get a bank line of credit on it if you want. And so what you're getting is all of that and a pool of money that's growing with a whole lot more control. A lot of people think about money and say, I can do this or I can do this. This is an and asset. You can do this and you can go do your deals. You don't have to pick. A lot of people are like, well, I can't commit to that higher 4 or 5 years. And I don't know if I can do that. We have levers we can pull and design to where in year 2, things are rocky. We can pull down how much somebody's putting in. Things get better. We can pull a lever. We can pump it back up. And then, we'll show you quickly the 5%. It's not really 5% unless people don't service the loan, which we have a lot of flippers that intentionally don't pay back until their flip is done or the deal is done, or in lending until the money comes back. So here's an example of how it's calculated. This $50,000 times 5% is $2,500. You divide that by 365 days, and the charge is $6.85 a day. And let's say it's a 7-month real estate flip. The money stays out for 210 days. It cost them $1,438. Divide that by the 50. So the only way it costs you 5% is if you hold the money out for a full year, which you can do. And there's nothing wrong. There's nothing wrong with doing that.
It's different than
this is an average daily balance loan versus what most people are used to is an amortized loan. You can think about it like your home equity line of credit with no required monthly minimum payment. As far as the banks do it on a 360-day because it's to their favor, but it's pretty close. Another misconception is, hey, I'd like to keep funding this past 7 years. Well, you can. We just showed you 7 years for a few reasons. It keeps it tax-free. It's long enough for it to be a great thing. We can have levers. Most common uses, and I'll be quiet, real estate deals, flipping, private lending, cash that you put in an investment, debt reduction, down payments. The biggest to me, and I think Steve, I want to say, I don't want to speak for you, but being able to teach your family and your kids how to do private family banking, because a lot of times wealth doesn't make it past 2 generations. Like you may be doing this, I may be doing it well, but if I don't teach my kids and give them structure and have a warehouse that is safe, for them to learn, it's not gonna, that was Nelson Nash's biggest thing, was that if you don't teach your kids, it's not gonna go on. And then obviously it can be a great legacy, but to something I've heard Steve say, if leaving your kids money is not great unless you leave your kids the wisdom and knowledge about what to do with it. Money alone is not gonna be good enough, but it's a great teaching tool. So we just fed you with a fire hose in about an hour. Appreciate everybody holding on. We're game for questions if you are.
Yeah.
I'm gonna just open it up here for questions. So we have tons and tons of questions. And John, I want to just ask this of you, because some of the questions are coming from people who do have an understanding of infinite banking, and it might require perhaps another call and where they're looking for clarification. But would you be willing to do another call with the community at some point, and perhaps just a question and answer call?
Mm-hmm.
Yeah, it'd be happy to. I think that the one thought is that if people weren't on this call, that's gonna be pretty crazy for them. But yeah, we're here to educate, and there's a lot of them. So I don't know, Steve, if you want to
talk, I guess.
If you want to.
So there's many of these questions. I mean, I've been through this enough. I can answer a lot of these, but can you do this with money from an IRA? It's advisable not to because of the tax-free structure, but I think it's something that's possible, but it's not advisable. John, do you have anything to add to that?
Yeah, you don't want to stick these inside a self-directed. Those are sadly under attack already. IRAs, there's sections of the government created those plans, and they have their uses, but you don't want to put an infinite banking account inside of an IRA now.
So there is the idea. We've got questions in regards to the universal policies that they've had some pretty high earnings in recent years. There's a number of people who are talking to somebody who is offering them a quote unquote infinite banking policy with the universal life policy, indexed universal life policy as the underlying method for building this out. What they don't understand is how can those go backwards? And if I understood you correctly, just to maybe put some things in layman's terms, is that there's a difference in the whole life policy in the sense that there's a guarantee as far as what the return is on that policy all throughout. There's a point when you're finished paying for the insurance, but the universal life policies, the cost of the insurance on an annual basis can begin to exceed what the policy is actually earning them, and therefore they have to start drawing off their cash reserves in order to maintain the insurance. Am I correct when I say that, or does that need further clarification?
That's a big piece of it. The other is that those index universal lives it's like, hey, well, it's tied to the S&P 500. I could do really well. Well, the insurance companies control your participation percentage. So if the S&P goes up 10%, when you start out, they say, hey, we'll give you a good bit of that, and you'll get locked in on that. But what they do is they control that, and they start turning down the dial to say, how much of that participation are you getting? Or they cap you and say, they have different strategies you can pick. One of the companies I work with has a really great one for that basket, but they can and do go backwards in value, because what the company, they can also increase the cost of insurance on you inside there. But the main one is that it starts out looking really good in the early years. Also, they have a surrender charge. So once you're in, you're in. They usually have a 10 to 15 year time to say, if you walk away, then, so what happens is you get stuck. And then they turn how much participation you can get down, and you're in. They do have some minimum baseline fixed earnings offerings, but the cost is going up. So it looks rosy when you're younger. It doesn't look good as you age and cost. But that's the big they illustrate, you can make them look really good, but they don't pan out that way. And that's an investment. And if people want to invest involving life insurance, that's fine. This is for the safe money, because I think your return that you do learning in this community, the returns you can do in real estate and all the other strategies, those are gonna be way bigger than an index universal life return. So make your warehouse a safe one and chase your investments and pure investments.
So, John, before some people have to run here, some people have been dropping off. Can you give your contact information for anybody that wants to reach out to you?
Sure. I can post in the app, or
You give me that, I'll type it in the
Yeah.
chat
If
and
you'll post it in the app, that would be awesome, and maybe
Yeah.
put it in the chat as well. So while that is taking place, I'll just ask you, we just talked about, hey, here's some of the issues or challenges with the index universal life. What are some of the issues or challenges? If I'm talking to a IUL, somebody's trying to sell me that kind of policy, they're telling me why I shouldn't be in the whole life policy. What are they telling me? What are they saying are the drawbacks to the whole life?
they're going to say, hey, that's slower. Look at what the stock market interest rate indexes can get you. You can get more. And whereas that's an if. There's risk there. They're gonna say, hey, you could be getting 8-10% a year over here. And starting out, you might, if the stock market does that. What the companies almost always do is they turn down how much of that stock market index performance you get. And so, but you're stuck because you have a surrender with IBC. If in year 8 or year 7, when you have all the money you put in, if you don't like it, you can walk with your money. Whatever your cash value is how much you can borrow against of their money while yours grows, but it's also walk away. I don't know why you would walk away after, now that you've built an ever compounding tax-free machine, but you could do that. Whereas with the IULs, you're really not going to be able to walk away with your money because they put surrender charges on you.
All right, so there was a question earlier about inflation and what happens if interest rates and stuff do go up. And in this particular case, I'll tell you what I like about this is that I could have this policy in place, it could continue to grow. And let's say we had a repeat of the 1980s, and all of a sudden I could go into the bank and get 12% on a CD. I could literally just borrow the money against my policy, pay the insurance company 5% because that number is locked in, and I could take that money to the bank and go get a CD that pays me 12%. And so that's a strategy. So where inflation may kick in and there's opportunities for us to make a lot more interest, we have the ability to be able to do that. This is a question that I was asking over and over and over. Could I buy a $100,000 policy up front and use the cash right away? For me, that question is, Joanne, I had asked that question repeatedly. I wanted to know how much of my $100,000 could I use right away? And I will just tell you that this is from my experience, and if John wants to give further clarification, he can. I think it depends upon how your policy is structured. There's a number of different factors that can come into play, but these are custom designed to help you to achieve your goals. Part of it is going to do with your age and your health and where you would fall in. But the last one, with just some guesses, a few assumptions on my part without me actually going through the health exam, was if I were to agree to put in $100,000 a year, in year 1, when I put in my 100,000, 82,000 of it would be immediately available for me. Year 2, when I put in another 100,000, it would be right around 182,000 that would be available for me in year 2. My cost was around $18,000 right away in year 1 that I would have been putting in that I would not have had access to. So that number is variable. I've spoken with some people who told me that if I put in 100,000, I'd have 50,000 available. And this is where John and I have had many discussions about, well, this is what would be important to me. I want to have access to my cash. I'm not interested in putting in $100,000 and only having access to 50,000. So he has, really listened, and knowing how I would like to see the policy structured and knowing the investors that we have in this community, I think that we would all be thinking in similar terms that, yeah, if this makes sense and I could put money away with a guaranteed growth, that it's protected, it will continue to grow for me, and I can still have access to just about all of my cash, yes, this makes sense to me. And John, is there anything that I said there or that I misrepresented or that maybe you'd want to clarify?
Yeah, it's based on what somebody wants. In Steve's case, he wants the most available in year one. And so he wants that. And some people there's apparently a lot of people that have pretty strong opinions in the community on it, just kind of glancing through. I personally like more of I'm okay if I did 100,000 to lose access temporarily to 30,000, because that design, because I'm looking at this not over 7, 8, 10, I'm looking over this as a warehouse for me to do deals with over my lifetime. And whereas if it's all about immediate access, then Steve what he wants is perfectly fine for him. It really depends what you're going for. And there are arguments to be made on both sides, but Steve's what he was asked for is, I want the most available. Well, that can be done usually at that ratio he's talking about, but it's going to depend on everybody's age and their health and that kind of thing. But there's a lot of levers we can pull in design and doing that. One person was kind of saying that whole life is riskier than IUL. I would disagree big time with that one on a lot of levels. When you're an index universal life person, you're a customer of the insurance company, and they're profiting off you well. And when you're a whole life policyholder, you are a part owner in the company. So these companies that we use have been in business for 200 years. They survived the Great Depression. They bailed out Wall Street, and that's why we have the big time tax advantages to life insurance, was because of that. If the whole life insurance companies are going down, all the stock market returns are what I'm saying is the mutually owned, these are the ones that are too big to fail. I can't argue with that. I'll say this, if the mutually owned life insurance companies are going down, then it's already pretty bad, because they're like one of the strongest pillars. The other reason is when you put money inside a whole life contract, that they have to keep that and a reserve on top of it. In IUL,
these policies can attract, could you connect due to stock market performance?
Yeah, so somebody's saying that the whole life policies become a trap because that stock market performance can make them a mech. Infinite banking whole life has nothing to do with the stock market. So that's not correct, which is okay. There's a lot of misinformation out there. Google it and your head will spin, for sure. One thing that I would have to do another call.
There's a lot of questions.
So many from all over from left field.
So I'm gonna try to get through. There's a number of these that are going to be specific to a different person. Can you fund it all at once, and is there an advantage to doing that? Garcia, I've asked that same question. The reality of the situation is you cannot do single pay policies anymore. That was where that MEC line came in. The government put a law in place that it has to be funded over the course of 7 years. Now, having said that, there are ways that things could be structured to where your money is sort of put aside. But someone else, along with a concern that was brought up earlier, is what if I cannot, fund or honor my obligation? So let's say you agreed, and I'm just using round numbers. If you agreed to put in $100,000 a year for the next 4 years and then drop that down for 3 more years. There needs to be 7 years of contributions. But let's say you put in the 100,000. This is my fear is like, hey, I can't presume upon the future. I don't know what God is going to do or what I'm going to have. And I would want to start a policy and put in as much as I could possibly put in, but I just don't know where I'm going to be in 3 years or 4 years. And so I don't like making those kinds of commitments. However, let's just say, and this is something that I've thought of, and this is not this is not the best way to utilize the policy, but I just want to say that this is quite doable. If you had $100,000 today and you put the $100,000 in, and 82,000 of it was immediately available to you. If you didn't use that 82,000 and next year came around and you needed your next $100,000 payment was coming in, theoretically you could borrow the 82,000, come up with another 18 and make your $100,000 payment. The next year you could borrow against your policy again and make your payment. You know, there are those kinds of protections, but I also believe, if I'm correct, because I had asked a question, I think someone had said in the chat that you lapse and you sort of lose your policy. I don't know that that is the case. John, maybe you can give some more clarity in that particular area.
Yeah, I'll touch on a couple of things. One thing, and so let's stick with Steve's 80,000 or 100,000. Instead, in year 2, if he couldn't come up with another 100, he would just pay 20 and everything would be fine. He wouldn't have to borrow the 80 and come up with another 20. He could just do that lower amount and he could catch back up later. The other thing is you can do single premium deposit into IBC and push really far in this line. You can do it, but the reason I didn't tell Steve anything about it is because that would be a taxable account and that's not what we're going for. So we don't do those. I know people who do for some other reasons, but they're in a really short-term window. Sometimes people are just looking for credit protection, quick kind of thing, but you could, and they're just levers we can pull to say, if we stuck with 100,000, hey, I can't do 100 this year, so I'm going to do 20. You could skip that higher amount and then catch back up. So the 7 years, you know, if someone's like, hey, I can't do year 6 and I don't want to try, just they could walk away with their money if they could quit. Whatever your cash value is how much you can borrow against or how much you can walk away with. But you walk away from, you've essentially already gotten past the hard part, which is year 1, and hopefully people are already using it. The power of it is not the tool itself. The power of it is what you do with it. Yeah, you can have it growing and compounding. The power is the deals that you do with it and the control that you have. Because right now, banks will loan money to anybody that'll fog a mirror, but that wasn't the case in 2008, 9, and 10. I know a lot of real estate developers going under, people having lines of credit called in. And if they'd had a place to shelter and have the control, there have been some not as sad stories come out of that. I don't know if I got to all the ones you wanted to say.
So I'm just rolling through some of these. So Fred, you had asked if the insurance company is charging you to borrow your own money. You're not borrowing your money. Your money stays intact in the account, and the insurance company uses your money as collateral. So you're actually borrowing their money, and the agreement is upfront. You know, if interest rates, let's say 10 years from now, interest rates for a 30-year mortgage are at 8%. Your agreement with the insurance company is that you could borrow at 5. You don't, because that is what was set in place today when you set up your policy. I don't know how that fluctuates over time. If we're in a different interest rate environment 3 years from now, where interest rates were much higher, John, would the guarantee on these policies be higher, and or how stable or how long have they been at this 4%?
Are you talking about a loan rate or like the
growth rate for the whole life policy?
It's been at 4 for quite some time, and it's going to change. at the beginning of next year. So all the contracts done prior to many years ago till now are gonna, I think Keith's had that question. There you are. Had that 4%. That is not, this is gonna be too confusing for the call, but basically I've been involved in making sure that, at least with one of the companies I use, that the new, it's called a non-forfeiture rate, that rate, that the policy will be just as good, because there's a lot of ways that they can make, it's all about the guarantees. And that's what you look at when you look at illustration. You look at the guarantees, because there are a lot of companies out there that illustrate not realistic dividends that their balance sheet can't support, but they do it to get new customers, and then they have unhappy customers. But the companies we use are illustrating dividends in our current very low interest rate environment. And if into another one of Steve's, if interest rates spike, I actually would like it. Personally, I would love interest rates to go up. A lot of people don't. I think it would be healthy for us, and a lot of good would come from it, but that's a personal opinion. One reason I'd like it is because I can borrow at a capped contractual rate at max of 5 for life, and then I can go do a variety of other things. And if interest rates go up, dividends will come up. Historically, dividends rise and fall with interest rates. So it would be good for the actual policy, and it would be good in a lot of other ways for opportunities. I know borrowers don't like high interest rates, but they're
so
good.
one thing that I was hung up on for a very long time, and I have a better understanding, and I still don't 100% understand this. And I don't want everyone to just start asking questions on this, because it's a little more complicated. But in addition to your guaranteed contract that you have in place, and for purposes of this, let's just say that you have a guaranteed contract where you're making your 4%. The reason why they use a mutual insurance company is you are, as a policyholder, you are one of the owners of the company. And as that company earns money as an owner, you get dividends. And so in addition to your policy, you also get dividends. And I think that's where John was just going. As interest rates go up, you're also going to see the dividends going up. Right now the dividends are less, just simply because of and the dividends are going to be like a percentage of the earnings of overall. But I don't understand that part of it. I don't understand how they calculated it. But the point being is that in addition to your 4% guarantee, as long as the insurance company is profitable, they're paying dividends, and these companies have paid dividends for 200 years without missing. So it's 4% plus whatever your dividend, and some of that goes into offset costs of your insurance and things like that. But I just wanted to put that out there. If I completely misrepresented that, John, then correct me, but I think I'm getting more of an understanding of that. It's not a percentage of how much is in your policy. It is the dividend for being sort of a policy holder makes you an owner of the company, and you collect dividends based off of the earnings of the company.
Yeah, the dividend, the way that the formula is a fixed, not changeable thing. At the end of the day, they're not guaranteed, but based on the declared rate that the company declares, it's not like, oh, we're gonna more to this one. It is everyone, all the 46-year-old females of that health class that have that same design are going to get the same exact dividend. So it's not a picky choosy thing. I think he's asking, so if we expect, but yeah, overall you got it. The dividend formula is confusing, for sure. So Keith Blackboard's asked, so if we expect interest rates to stay low, do IULs make more sense? If you trust that, if you think low interest rates means high stock market, if that's like where that is, and if you want an investment with your life insurance where you don't have the guarantees, look at the guarantees on the IUL and then compare it. And they're not going to be close. Because the other thing is, in the fine print of an IUL, Keith, is that they can increase your cost of insurance. They can also, and it's a pretty big number. And then you can head nod, are you a participation rate or a cap? So are you? Yeah, you can.
I'm evaluating my options now.
Okay, all right. I didn't know if you already had one. But yeah, so you're going to go participation rate on the S&P 500 or the Russell 1000. And when you first get in for new customers, they're going to give you good participation. It's assuming that year, from your anniversary to anniversary is good. But after that, they can go, well, we're not going to give you as much of that potential return of the market. And then the other thing is the surrender charge. They've got you can't walk away. But I would look at it as guarantees, because if you're going to put your savings bucket, if you're saying, hey, this is my savings bucket for me to do deals out of, then I would just look at the guarantees of each at that point. But if you're saying, hey, I want snazzy potential returns, and I'm willing that this could go backwards, meaning an investment, then IUL might be for you. As far as interest rates, if interest rates rise, the stock market, who knows how it would do. At first, I think it would not like it. Every time the Fed threatens to, or even mentions raising rates, the stock market doesn't seem to like it. I don't have the crystal ball there, but I think whole life is good. If as an efficient warehouse for savings is good in low and high interest rate environment, because I'm more interested in having a safe, sustainable, predictable warehouse, because the real power of it is what you can do outside of it. And I can have two assets instead of one. Nelson Nash would say it was the iceberg. If anybody's seen a picture of an iceberg floating when you can see below the water, what we look at, and we look at a policy, is above the water. But the iceberg below the water, the unseen, is way bigger. The unseen is the cool stuff that our clients do with it all the time. That's the unseen, and that's the more exciting part, is working with people, watching all the cool stuff they do with it. That's what we really enjoy that.
So I want to give everybody sort of a little bit of a practical application of something that we're considering right now. And this is on a smaller level, but this just helps you to put some things into perspective. I want to go ahead and get a policy set up for each one of my kids. And the reality of the situation is we're spending a significant amount of money on their private school each year right now. And so what we will do is we will go ahead, get a policy set up. Instead of the money that we save and put aside for their private school, we're going to go ahead and fund one of these accounts. And so when the account is funded, we're now going to go ahead and borrow against that account the money that we just saved up. We're going to pull it back out and pay for their tuition. And then each month, as we save, we're just going to pay down that loan. And so that ends up now, over the course of a year, we pay back what we borrowed, and then we borrow it again for the next year, and then we pay it down and we borrow it again for the next year. But we're going to do that with our kids to put those policies in place. And then when our kids are finished with their private school, they're now going to have these policies in place, whether or not I give them control of it or I maintain control of it for myself, because that was a question that someone had. I can maintain control of those policies. They can just be on my kids. But maybe they want to buy a car. I would lend them the money from this policy to buy a car and have them just pay that policy back. And so it's a good way for me to begin to start building something for my kids as well. But that's just a practical thing. The thing is I put that money in there, and now it is something that I'm using for my kids' tuition. It's going to continue to grow. It will be invested. It will be protected. It will be guaranteed. There's a death benefit that's associated with it. Lord, I don't ever want to have to collect on that. But, there's all kinds of benefits for this money that we're just saving and putting aside into a savings account so that we can pay for their private school tuition at the end of the year. And so that's just one small way to do it. People who save up to buy a car, put it into this kind of policy, and then borrow the money. And then as you're going to save up to buy a car again, instead of saving up, just pay back that loan. The money's still there. It's still in your account. And then you just have it to do all over again. But then when you can get really creative with it, you start to build some cash value here, and you start lending it to other investors, you start using it for your own deals, you start using it for your own flips, your money always stays intact. And it's continuously growing while you're using the insurance company's money that you theoretically don't have to pay back. If you never paid it back, when you die, your death benefit actually pays back the loan. So there's a lot of benefits to it. Any thoughts or questions on what I just shared?
Steve, really appreciate you allowing us to come on and unpack a lot of information. Sadly, thanks to Google, and it's a great tool, but there's so much misinformation out there that I almost don't even look anymore, because unfortunately there's a handful of people not doing this the right way, and it gives it a bad name. It's really common, but there's so much information that it's just taking upon myself to try to present it and not sensationalize it, black and white, and try to help people understand if it's a fit for them, great. And if it's not, that's okay. It's just,
well, I'm going to ask you one more question while I still have you.
Sure.
Because to me, I think this is always important. I'll just come right out. Do you have these policies for yourself? And if so, how many?
Yeah, so I show people that ask. I don't show them all. I can, but I have 5 on myself. My wife has 3 or 4. We have 11 in all. My daughter has 2. My son has 1. And the reason, when I started, I think one of the questions, what's the smallest amount? I think my first one was like a couple $100 a month. That's too small to do infinite banking now. And it really wasn't much one. But as we progress, we would say, how much do we want to warehouse here? And that's not the end place for that money. That money is growing and protected from taxes. And then the real opportunities are, what can we do with it? And that while it grows, so it's going to continue to grow, what deals? And that's why I'm a member of this community, is to the idea sharing and learning how to all the different ways to learn about passive income, because I'm fascinated by it. But we have 11, and we'll see how much more capacity we have to do it with. So, but yeah, I
love asking that question, because a lot of people promote things and they don't invest in it themselves.
No doubt.
I know, and I knew how many you had from previous discussions. The last guys that I spoke to were telling me guaranteed 8 to 9%, and I got to tell you, it just seemed too good to be true, and it was. They were inflating everything. They were telling me what the top end dividends could be combined with this, and never talking about anything negative. But it ended up, the one guy who was sitting there pitching it to me didn't even have one of his own policies, and that he wanted me to buy, and it spoke volumes. With that in mind, I also just want to say that one of the reasons why I was comfortable and very comfortable in talking with John is that one of the people who I coach, who happens to be on the call with us right now, Jason Holland, has been doing infinite banking now for a little while, and John is the person who set it up for him, and it was Jason who made the introduction to John. And so I had been able to get a real life referral from someone. And Jason, if I'm correct, the one thing that you have told me is that you wish you would have started it sooner.
Sure, yeah.
That's the biggest thing.
Absolutely. Yeah, it's been great. John's been great and did a good job on the presentation.
Thank you, man.
I think a Q&A only call would be a really good idea, because it's so easy to get in the weeds. That might be one of the downfalls, in fact, is that it's hard to explain in a nutshell.
So here's what I like to do then. We're going to go ahead and get this one wrapped up. But John, I would love to go ahead and begin to solicit the community for questions that they would want to have answered on an upcoming call, so we don't go down all these rabbit trails, and perhaps we can go ahead and sort of categorize some of these questions and put them into the same buckets and get them all answered, and then maybe take some questions. But I want to encourage anyone that has any questions, go into the app and start asking those questions. John is in there. We'll get a call set up for another 2 or 3 weeks out. And I would say next week, but I'm going to be on vacation next week out on the beach. And so I won't be hosting a call next week, but maybe the week afterwards, we can get something on the books. And asking about the replay, we always get the replays out. As soon as Paula gets to it, she'll have the replay out there for the community. But John and Ashley, thank you so much for your time today. We appreciate it. And this won't be the last one. We'll have more calls.
Thank you, Steve. Thank you, guys. Enjoy.
All right. Have a great day, everyone.